Thanks for joining us today on Market Call. I'm Morella Fernandez. David Driscoll on the show with us, President and CEO of Liberty International Investment Management. He'll take your questions on global stocks. Here's how to reach us. 1-855-326-6266. If you would like to dial in, you can reach us through email as well. If you want to send your question in, marketcall@bnnbloomberg.ca. David, good to see you.
Hi, Morella. It's been a while.
Markets rebounding today, as you can see on news that the Strait has reopened in the Middle East. What do you make of this enthusiasm? Is it premature?
Well, I think it's a relief rally for sure, especially in the European and Asian markets, because they're the largest importers of oil. So this drop in oil prices has got those equity markets rising. And we're also seeing a surge in bond prices as well. So if this truce goes through, then the bulls will be on target, on a revisement in better performance in the stock markets, on the expectation that interest rates may be on the way down in the United States. It's also why we saw the US dollar fall today and gold go higher.
Okay. IMF officials are saying investors aren't really factoring in the longer term fallout from the conflict. I'm wondering if you agree on that.
Well, I think there's some hesitation going on among, shall we say, clearer heads, just given where the markets are right now. But really, we're going to find out in May. The next step in the process is what happens with the Federal Reserve and whether they actively start to cut interest rates. That's always been the plan by the White House currently, and Scott Bessent recently said that he was going to, he sees no reason that inflation is fairly muted and that they can continue to cut rates. So if they get Mr. Warsh in there as the head of the Federal Reserve, then we'll see cuts in interest rates. When interest rates go down, stock prices always go up. The only cautionary tale would be, number one, oil prices aren't back to where they were at the beginning of the year. And number two, if the US dollar goes down, then you're going to see the US start to import inflation. And we could just see continued growth in the commodity sector, which could just continue a bull market there. Last year, the US dollar was down 7%, and it started to fall again this year, too.
Would you trim in certain sectors at this point? If so, where?
Well, for some of the stocks that we've been holding in the last year, a few of them have doubled, tripled, even quadrupled. And it's just very important in this kind of environment that don't take anything for granted. Don't think that markets move up linearly. And it's always best to take some profits off the table, especially with high-flying flavor of the day stocks or those that have high betas.
Okay, so are there certain industries you're looking at where you would trim more specifically?
Well, it'd just be everything that's in the hot areas right now, which would be semiconductors, the chip manufacturers, pretty much among the areas where there's data centers being built. So anything that gets beyond what valuations suggest would certainly be the ones that need to be cut back. We always go by, if we have 30 stocks in a portfolio, an average weight of 3% each, and one of them gets to 6%, we'll automatically pare back. And one of the stocks that we bought last April, May for $300 was Comfort Systems, and it's up over $1,600. So the prudent thing to do is to rebalance and bring that percentage weighting back to neutral, so that we don't end up getting caught with any kind of a market sell-off if we do get higher inflation.
Let's take a quick break then, David. We will come back with the first phone calls for David Driscoll of Liberty International Investment Management. Again, he'll take your questions today on global stocks. Here's how to reach us. Back in just a moment. Welcome back to Market Call. Let's go to an email from Chris to start. He's got a question today for David. He says, could I please get your guest's opinion on TD, please? David, we know TD had a run up from a base after it got dinged in the U.S. and had its U.S. assets capped. Where it is today, would you put more money in? What do you think of TD moving forward?
Well, a few things. Number one is we've had tailwinds for all the Canadian banks in the last year. We saw interest rates fall with the Bank of Canada cutting rates. Deposit rates fell along with renewable mortgages coming up at higher rates from the 2020s. So that net interest margin really started to expand. Higher stock markets lead to better performance among the wealth managers at these banks. You've also got mergers and acquisitions starting to pick up pace again, and then heightened trading activity and volatility going on in both stock and bond markets were really helping the banks. As you said before, Mirella, TD kind of went into the penalty box after they got caught with all the compliance issues in the United States. They're still there. They cannot open new branches or make acquisitions in the U.S. until the Federal Reserve gives them the green light that everything is back on track and they're allowed to do so. We had the big run up in TD shares last year because it was really the recovery with these tailwinds coming back after the big sell-off in 2024. The banks are all hitting new highs right now because not a lot has changed other than the fact that we've got Canadian mortgage volumes. Recovery is not as strong because home prices continue to fall. So that could be a red flag for 2026. And then it all depends on what the economies and interest rates do moving forward. In the meantime, two things I've noticed about the banks that's interesting is that they've been buying back a lot of their shares. So they're allocating capital that they can't use for expansion into buying back shares, which of course helps the bottom line. And secondly, you've got a lot of ETFs out there with these covered call financial funds that consistently have to keep buying shares so they can write these call options against them. So unless we really get higher inflation and interest rates rising, I imagine the banks will continue to grow in Canada. I just don't think they're going to be at the pace that they were last year, that there could be a little more hiccups along the way.
That was for Chris. Let's move on to our first caller then. Rob's on the line. He's in Calgary. Rob, go ahead.
Hi, thanks for taking my call. Staying on the banking theme, I'd like to hear David's opinion on HSBC. I've held this stock for a number of years, and it's had a fairly consistent run lately, and I'm wondering if I should continue to hold and take some gains or to reinvest in another European, Canadian, or American bank. Do you have a preferred international bank or geography, and or should I stay with what I have? Thanks for your advice. Have a good afternoon.
Thank you for that question. What do you think of HSBC, David?
Well, HSBC's been in reset mood for the last few years where they were selling off assets to maintain their ability to keep their fundamentals in place. When you think of the banks, you have to consider the following ratios. So it'll be net interest margin, because that's where outside of fee income, they're making their difference, the spread between what they're taking on deposit and lending out in mortgages. We've got the efficiency ratios. How are they managing their costs? Capital ratios, return on assets, loan to deposit ratio. And when you look at it and put it all together, HSBC has actually been performing better than expected because they have started to clean up their balance sheet. The last year, the stock was up 82%. So there's no reason to get rid of them right now. If we do get a return to better markets, then they should continue to grow. The emerging markets have actually been doing a whole lot better, and that's pretty much where they're based to take advantage of opportunities there. We own Svenska Handelsbanken, one of the larger Swedish banks with exposure to the Nordic countries and England. It's a little safer bank and more, I guess, disciplined than HSBC, but there's nothing wrong with continuing to hold HSBC shares.
That was for Rob. Let's move on to Michael, who's in Vancouver. Michael, go ahead.
Thanks, Mirella. Thank you, David, for taking my call. David, my question is on Enghouse Systems. I know at one time you did like this equity, but you have exited. I'm underwater, and I wasn't smart enough to sell it like you were. And I just wondered if under $20 here, in between 17 and 18, whether it's now good value or is it a value trap? I'll hang up and listen to your response. Have a great weekend to the two of you. Bye for now.
Thank you for that. David, go ahead.
Well, thanks for that question. We're probably not going to know until 2027 what the outcome for all of these software firms are going to do, because we've heard of SaaS apocalypse going on, that artificial intelligence is going to put pressure on these software companies. If you think over the last 40 years, they had pricing power, they were making 40% margins. Now we're going to see moving forward as to whether AI is going to be able to replicate or do the coding that the software firms had licensed to make profits from, and what the impact's going to be moving forward. As a result, we've seen pretty much a PE multiple contraction among all the software companies, and that's why they've come down from 40 times earnings down into the 10 to 15. There's some people that are buying on the dip right now on the expectation that this is overblown. So you really have to decide yourself as to whether you want to continue to hold these, hoping that things are okay now and that there's only nowhere else to go but up, or if AI is going to continue to put pressure on these software firms, then you could see prices going sideways for a while or down. We sold our software companies because we had a number of them and suffered from it last year, because that was the Dassault Systems, the Roper Technologies, Enghouse as well, even the Thomson Reuters of the world. That if AI is going to have that kind of impact on software companies, then it's just not a place that we want to be.
So you got rid of all of your software stocks?
Yep.
Wow. Okay. On that note, let's take a quick break. We'll be back with David Driscoll of Liberty International Investment Management. Again, he's taking your questions today on global stocks. Back in a moment. Welcome back. David Driscoll with us today to answer your questions. Paul's on the line. He's in Prince George, BC. Paul, go ahead.
Thanks for taking my call. Mr. Driscoll, I've owned Microsoft for a few decades now. Until recently, it seemed to be in an unending downward spiral. I've sold it all, and it looks like it's starting to recover now. I'm considering getting back into it. What are your thoughts on Microsoft? Thank you.
Thank you for the question. Sorry, David, go ahead.
With Microsoft, you have to remember hyperscalers are the ones that have the power right now. So you can think of the Mag 7, Amazon, Google, Microsoft, NVIDIA, who are the ones that are going to be introducing the next generation of chips. If quantum computing comes along, Microsoft is already there. They're the ones that are building the data centers. They're in the cloud with Azure. Microsoft got hurt because of all the downdraft talk about software itself, but they have to understand that behind Microsoft, unlike many software companies, is this big behemoth in the hyperscaling ability. They've got OpenAI that they've been able to leverage, and we've owned this stock for a couple of years. We bought it at 300. It went to 555. We're back down into the 428 range. It's been moving recently, and it's really because it is deemed to be fairly cheap relative to its peers. So I think the stock's probably going to start to have an upward movement, only from the standpoint that, yeah, they got hurt because they weren't spending as much money on data centers as the others were, but they're just taking their time making sure that everything is going to be aligned so they can capitalize on profitability. So at this level right now, I think it's a very attractive bar.
That was for Paul. Let's go to Pete. He's in Sherwood Park, Alberta, with a question. Pete, go ahead.
Oh, good morning. I've got three of the six Canadian banks. So what I'm looking for is international exposure to the banking index, and whether it's a stock or an ETF or an index. I suppose I would prefer an index and get away from the problems with covered call options with ETFs. And if you don't have a banking thought, anything else that's high dividend that can hold for, say, 10 to 15 to 20 years would be great advice. And David, I followed you for 30 years, and your brilliance is quite something.
Thank you for the question. Okay, David, is there a suggestion in that vein?
Well, I'm feeling very humbled right now, but I think the best way to get exposure, what we've seen so far this year, as the U.S. dollar has been falling, is a continuance of those emerging market currencies getting stronger. And last year, the MXEF, the MSCI Emerging Market Index Fund, was the best returner. It was up over 30% last year. And the way to think about it is that if the US dollar is going down, those home currencies in the emerging markets are starting to rise through not only getting stock price movement, but you're also getting a tailwind relative to the Canadian and US dollar. So the broad index would be MXEF, Michael, X-Ray, Edward, Frank for the emerging markets. I'm sure there are other ETFs out there that are just focused on international banks, of which there are many, whether it's in emerging markets, Europe, Asia type of index fund or ETF. So those would be the ways to go. For us, we own 3 banks. Royal Bank covers us in North America. Svenska Handelsbanken covers off continental Europe. So that stock symbol is Susan Henry Baker Apple in the Stockholm Exchange. And we also own HDFC Bank out of India. And that's really on the fact that if the Indian government ever gets rid of their corruption and gets their infrastructure planning in gear with a population half under the age of 30, they could be the next superpower in the next 50 years. So that stock had come down, and it's really cheap right now. It does have an ADR. It trades under the symbol Henry David Barbara, HDB US. So those are opportunities, or just, I guess, ideas that the caller could investigate.
Okay, HDB, you said, correct?
Yeah, Henry David Barbara.
Barbara, thanks. Okay, let's move on to our next caller then. I think it's Joe on the line in Montreal. Joe, go ahead.
Hi, thank you. I want to ask your guest about Bank of America. I have it in my cash account. I'm retired. I want to ask him what he sees in the next 3 years, and does he have a price target on this particular stock? Thank you.
Thank you for the question. David, go ahead.
Yeah, well, I don't do price targets because I'm not a brokerage analyst, so that's off the plate. In the United States, the banks have not been performing as well as the Canadian banks right now. They do have some headwinds from a slowing economy among the lower and middle class. And the fact that we have also got the fear of private debt out there blowing up, because a lot of the banks are sitting there with these types of funds on offer. So Bank of America is down about 1% year to date, although it did have a big run up last year. And it will all be dictated on 2 things: the direction of interest rates in the United States, because 40-year mortgages are still high in that 6 to 7% range. So if the Federal Reserve does start to cut rates, the idea there is that you'll get, with a cut in rates, more business demand because rates are cheaper and companies can borrow at lower rates. But also a drop in the US dollar could actually help the US banks and get foreign investors investing as well. But again, it's just a wait and see idea. We'll find out more in May with the changeover in the Federal Reserve as to whether the Republicans or the White House really do want to cut rates to 1%. If that happens, then I imagine the US banks will start to come back to life again.
And we should see some change on that front next month. All right, let's take a quick break. We're going to come back with past picks from David in just a moment. Stay tuned. Time to go through some past picks from David. These are from March 25th of last year, to just over a year ago. David, at the point you picked Chubb CB on the New York Stock Exchange at $291.40 US to $328.37 today. So 13% upside, 14% total return. Do you remember why you picked Chubb last year?
Well, it's one of the best property and casualty insurers in the world. Also because insurance prices continue to be on the rise with global warming. Things are getting more expensive for individuals to buy insurance. But they're very good at what they do. When you think of insurance, especially property casualty, you have to think of combined ratios. For every dollar of premium that you're writing, how much are you paying out in claims? And they're at 85% right now, which means they're making 15 cents on every dollar of profit that can go back into the business, into mergers and acquisitions, or a higher dividend. So it's always been the one that we've wanted to own. This goes all the way back to when it was Ace Insurance and it merged with Chubb probably 10, 15 years ago.
Have you held on to the entire investment? Have you trimmed it all in this one?
No. This one is pretty static in the portfolio. It's a good anchor because the volatility is very low on the stock. So it's not going to move around a whole lot. You're not going to get 50% returns in any one year, but at the same time, you're not going to lose or see the price drop 50%. It's pretty much like the banks. They're pretty steady over time.
Let's get to your next past pick from March of last year. TC Energy, TRP on the TSX, 69.79 at the time you recommended it, now to 81.15. So 16% upside, 22% for total return. TC Energy, I imagine, has had some fluctuations over the last a little while. I know they do energy infrastructure. They've got that sort of slowdown that looks end of March and April. Any information as to what happened there, and have you held onto the stock?
Well, natural gas prices have fallen, but again, you have to stay focused on what TC is all about. And as you said before, Morella, you hit it on the nose with infrastructure. So we're seeing more pipeline building. They're in Canada, the US, and Mexico on natural gas pipelines. They also own a piece of the Bruce nuclear power investments. So if you want to have this kind of electrification or export of natural gas and oil, TC is a good place to be. The dividend yield is very healthy. It's growing at roughly the rate base growth rate of around 5 to 6%. And that's expected for the next few years. And then we'll see moving forward as to how fast they're going to be growing beyond that. But it's still a stock that we want to hold. It has, it's a utility. It has very little volatility attached to it. And the dividend payout just continues to keep pushing the stock price higher.
That is TC Energy. Let's get to your third pick then from last year. Lagercrantz Group, LAGRB, and this is in Swedish krona. So it was 227 at the time you recommended it. It's 247.40 today. So 9% upside, 10% total return. I know they do specialized products, but can you explain a little bit more about what their business is?
Sure. When you talk about or think about the trends that are going on right now, Morella, think about serial acquirers, SERIAL. Unlike serial killers, these are companies that are small, so they're all small caps. Lagercrantz is one. They make sawmill parts or valves or backhoes, everything that AI can't touch, but they're very good at acquiring mom and pop companies. So if you think of, say, somebody who is running a plumbing business that after 40 years they wanted to sell it so they could go retire, Lagercrantz is very happy to come along and pay out at roughly 5 to 6 times EBITDA, as opposed to buying a publicly listed company that might cost them 15 or 20 times. So if they can grow organically, the revenue is about 3% a year. And then with these acquisitions, tack on another 3% in revenues, now you're starting to grow twice as fast as economic growth worldwide. The acquisitions that they make, they fall within returns on invested capital of 15% or greater, high margins, and as a result, the stock's been roughly growing at around a 20% compound annual clip for the last 15 or 20 years and will continue to do so because they're small and they've got a large area to expand into. So we have a number of these types of companies in the portfolio because those are the ones that we hope become those big, large cap companies in 10 or 20 years.
Let's leave the block right where it is. We are going to take a quick break. David Driscoll with us today. We'll take more of your questions when we come back. Welcome back to Market Call. Let's go to Paul. He's on the line in Edmonton. Paul, go ahead.
Hello. Yes, my question is relating to Brookfield Infrastructure Partners. If you hold Brookfield Infrastructure Partners in your cash account, there is a withholding tax. Now, is this lost money, or is this tax just temporarily held until you do and file your income tax?
Thanks for the question. More tax specific, David, but what do you think? Do you know that?
Okay, if you have any withholding tax in a cash taxable account, because their structure is set up not in Canada, you should be able to claim that back on your tax return. So better to have BIP in your taxable accounts as opposed to a TFSA or an RSP, because if you do have withholding tax, you're not able to claim it back. So that's the answer to the question. As far as owning Brookfield Infrastructure, we own the parent company, Brookfield Corp, because we want to get the dividends up from Brookfield Infrastructure, but also the fee income from all of the different private equity and private debt funds that Brookfield, the parent, runs.
So you like that better?
Yeah.
Okay.
Yeah.
Let's get to Michael. He's been holding on the line as well. He's in Montreal. Michael, go ahead.
Hi. Would it be possible to have the guest's opinion on Uber for a long-term hold, let's say 5 to 10 years? And thank you very much.
Thank you for the question. Uber is trying to partner now on autonomous vehicles. They obviously have a platform that might work in that space. What do you think of the partnerships that they're trying to create here, and whether that could mean some growth for Uber moving ahead?
Well, the challenges for Uber are going to be competition from Tesla and Waymo, which is Google. So if they can do the partnerships, then they can maintain their hold on pricing power and volumes that they do. I mean, if you think of the city of Toronto, where is all of this traffic jam coming from? I swear that every second or third car is an Uber. But the fundamentals of the firm are good. The next step forward for this company is going to be competition. And how many bums are they going to get in the cars? The only problem I have with the company is that from an ethical standpoint, I wish they would treat their drivers better, just because the drivers end up not making very much, have to own the car, pay for the gas, the insurance, and Uber's is taking too much share away from what the drivers can make. So I wish they were more in the, a model economically like Costco, where Costco tries to look after their employees by offering them benefits, et cetera, et cetera.
I know that's come
but
to
I think I think the biggest challenge right now with Uber is going to be competition moving forward. It's kind of similar to what Netflix is facing, that they've been raising prices, but now they're getting to a saturation point. Now the next step is, what are you going to do for your next illustration, or just what are you going to do next? Are you going to revert back to the mean and let the law of diminishing returns cascade your business and start to slow it down, at which point the share price would start to come down from the multiples that it's at? So again, we'll find out moving forward what competition is going to have as an impact on Uber's future.
Yeah, I know Uber, some of that came to head a number of years ago, and you never know, it could come back to bite them again. We'll watch that. Let's go to Adam in Toronto with a question. Adam, go ahead.
Hi, good afternoon, and thank you for taking my call. I just have a quick question about an all-in-one ETF. I'm, not an expert or anything like that, and I just want to do hands-off. So I was looking at XGrow and wondering if it's the right, risk level and structure for my goals. So I'm looking at 10 to 15 years of holding it. Should I keep it, look at a different ETF mix? Is there also, last question, is there advantage? I'm right now holding in my TFSA. Is there an advantage to holding in my TFSA or my RRSP or outside of that?
Thank you for the question, Adam. Can you tell me a bit about XGrow, David?
Sure. It's an exchange-traded fund to replicate the performance of the Sabrient Global Balanced Growth Portfolio. So it's a fund of funds, which is I'm not a big fan of. I'd rather just go with one fund. The other problem, the fee is kind of okay at 0.2. But my biggest problem is the allocation by country. Almost 56 to 60% of this ETF is exposed to North America, not the rest of the world. And then the split is about 80% equities and about 20% fixed income. So you're taking on a lot of risk. It's above average risk. So the range of returns in any one year might be plus or minus 30% with the 80-20 split. And yet the performance year to date is a little below average. It's at 4.95. Last year was a great year, up 29%, but the 5-year average is only about 10. So it's a little bit performing underneath what the expectation should be given what's in this ETF with these types of different ETFs.
Is there something else you'd suggest in that space?
Well, it'd just be easier to, if you want to get rid of the the correlation risk, go into an exchange traded fund that is all world, and if you can get it equally balanced, that'd be the place to go. I'm not an ETF expert because we don't hold ETFs, we own individual stocks and bonds. But it's just trying to find something that can give you good global exposure. Depends what asset mix you want to have, and then just make sure that the correlation is just not heavily weighted to technology in the United States or something like that, because that's been the flavor of the day, and these ETFs tend to get overblown because they start to allocate towards whatever is hot at the time.
That was for Adam. Let's move on to take a quick break. We're going to be back with more phone calls for David Driscoll of Liberty International Investment Management. Back in a moment. Welcome back to Market Call. Dwight's on the line in Goderich, Ontario. He's got a question. Dwight, go ahead.
Hello, David. I was wanting to get your outlook, please, on Canadian pipeline stocks. They seem to be going down lately with the price of oil, and wonder what you think of the near future. Thank you.
Thank you for the question, Dwight. David, go ahead.
The way to think about it, Dwight, is number one, energy security. And Canada is pretty much at the front of the line there relative to what we've seen in the Straits of Hormuz recently. Number two, Trans Mountain is starting to open up wider. There could be the potential for Keystone to be increased capacity or rebuilding or new building, so getting it all the way down to the Gulf of Mexico. And then you've got the Canadian federal government also focused on infrastructure and wanting to be able to find other trading paths with other countries not called the United States because of the tariffs. So if there's a sell-off in the pipelines right now, I'd certainly not be overly concerned about it, because moving forward, demand is definitely there, especially given that Europe, China, India are mass importers of oil, and we've got the stuff. So the dividend yields are fairly attractive. The opportunities are there for more infrastructure building going on, and we'll talk about that with the top picks in a few minutes. But definitely, I think this could be a very good time for the pipelines moving forward over the next 5 years.
That was for Dwight. Let's get to an email here from Susanna. May I have your outlook on TMX Group? Is this a buying opportunity? I know, David, you said you don't do target prices. That was part of the question. But basically, TMX Group, I'm wondering also whether their business is at threat from the same concerns about AI. It's sitting at 53.28 today.
Well, the basis of TMX Group is essentially trading volumes. We own the Chicago Mercantile Exchange, CME Group, in the United States because there's just a bigger market there rather than what's going on in Canada. But TMX saw increased trading volumes in the month of March. They were up 33%. So again, when you get heavy trading, lots of volatility, the VIX was up over 30% when the fighting started in the Middle East. So it's a steady gainer over time. They also make money off listings. AI, I think they're probably going to use it to more benefit for their systems and what they're able to do and provide. So the stock's pretty much been growing at roughly a 10 to 11% clip compounded annually over the last 10 and 20 years. So it's definitely a stock that if investors own it, they should continue to hold it.
Let's get to another email then. This one is from Max, CPB. So Campbell's has been so bad that now at this price, is it good for a long-term hold? And it has over a 7% dividend yield, which may or may not be sustainable. What are your thoughts on a company like Campbell's in the space we're in today?
Well, this is where you have to start to look at the changes in diet, because people are moving away from ultra-processed foods, sodium, which Campbell's has a lot of sodium in their foods. But at the same time, you have to look at the business itself. So similar to, Heinz Kraft and products that were always the go-to in the 60s and 70s, they're getting very tired. The company is not in any fear of going bankrupt, so the dividend probably won't get cut. But you're getting a 7% dividend yield, but also watching your stock price drop 40% in the last year. So you have to sit there and say, am I willing to get hammered on the value of the company just to get a 7% yield? In my mind, the answer is no. Costs have gone up, profits have come down. Their free cash flow is the same as it was it's actually lower since it was in 2022. And then you have to look at the return on invested capital versus the weighted average cost. And right now, the leverage that they have on their books is not working because the average cost of their capital is greater than what they're making on their invested capital. So these are the types of stocks that one should avoid over time, because this is the heartburn that people are going to get in these kinds of investments.
If they have already owned it and so are down hoping for a bump back, should they bother to wait?
It all depends on their situation, and every individual is different. It can be used as a tax loss sale against profits moving forward. But if they own it now, at some point, they're going to have to make the decision if the income is worth receiving as the value of their portfolio goes lower. So again, that's an individual decision that investors have to make.
All right, let's take a quick break. We're going to be back with new picks from David Driscoll when we return. Stay tuned. Join us Monday for Market Call. Tim Regan will be on the show. He is managing director at King West & Company. He'll take your questions on North American large caps. And if you miss Market Call, check out our daily podcast. Find it on iHeartRadio and other platforms. You can also watch full episodes on our YouTube channel. Let's get to new top picks from David right now. We're going to start with CNQ, Canadian Natural Resources. Just looking it up today, David, it's down, of course, about 8% on the news that the Strait of Hormuz is going to reopen. Would you buy in today? What do you like about CNQ down the line?
So I'd love to be buying more as this price of oil continues to fall. CNQ is the closest thing to a forever asset in Canadian energy. It's got 20 billion barrels of reserves that represent about 36 years of production at current rates. And then we'll get back, Marilla, to return on invested capital, because with, right now, ROIC is in the 15% range with oil prices in the 60 to 70 range. Their finding costs are, 40-ish, so they're making money hand over fist, which going towards dividends, buybacks, debt reduction. But if we see any kind of escalation in wars elsewhere, say, for example, China decides to block the Taiwan Straits, and the U.S. and China get into a kerfuffle, at $100 WTI, their return on invested capital jumps up to the mid-20s with a spread north of 15%. So I believe that this is a very good time to be into the resource sectors, the commodities, because if the U.S. dollar falls, all commodities are priced in U.S. dollars. So this is where we want to have exposure to gold, oil, and even uranium and fertilizer. So CNQ, the fact that it's falling today doesn't bother me at all, because we still haven't filled our entire position.
Got that. Let's move to your next pick, which is Bird Construction, BDT on the TSX. I'm wondering whether Bird will participate in infrastructure build-out in Canada. Is that one of the reasons perhaps you're tapping Bird?
Oh, yeah. And infrastructure, the federal government wants everything infrastructure related. So if you want to have roads, ports, airports, whatever, Bird's there. It's a small cap stock, not a lot of eyeballs on it. So this is when I like to get in early because it can grow on its own merits, but also grow again if they become a mid or large cap stock because more eyeballs will start to find it. Currently, over 75% of its combined backlog is in a collaborative model. So they've gone from cyclical contractor to more of a diversified infrastructure platform. They recently announced a record $10 billion in combined backlog, which provides multi-year revenue visibility. So where they, year over year, they were flipping back and forth between profits and losses, now we're going to start to see, or should see, steadier revenue and profitability growth moving forward. The stock is already up quite a bit this year, but I still think it's got a long road to go.
And they pay about a 2% dividend, so you're getting a little money on the side there.
And they're paying monthly as well. So that should continue to grow. If the free cash flow grows at the rate that I expect, then I imagine the dividends will start to grow with it.
Let's get to your third pick then, Diploma PLC. Tell me a little bit about this one.
Another serial acquirer, just like Lagercrantz, Marilla. They're in the aerospace, seals, and controls industries, which are niche markets that are not commoditized, so they have pricing power. And they run a playbook just like Lagercrantz, where they've got high margin businesses for each of the three subs that are in the 20% plus, the same thing with earnings per share. And these are mission critical, low cost components that everybody is in demand for right now. So the stock's done very well in the last year. They were expected on the street in the last quarter of 6% revenue growth. They came out with 9%, and then the stock shot up. The other thing that's moving the British small cap stocks is also they tend to be under the radar and are in vogue right now for takeovers. Last year, we saw Spectris, a small cap British company that we owned, get taken out in a bidding war with two private equity teams. Now I've got another small cap British stock, Intertek, which is quality control assurance. Its share price has jumped from 35 to 51 just in the last 3 days because it too seems to be in play. But these are the types of companies that I want to own, small companies that can grow over time that aren't going to be impacted by the technological changes of AI. So as opposed to owning software, these are the companies I prefer to own.
I was going to ask you, because you said you got out of all software. Did you hold on to any tech at all?
Oh, well, we've got tech. It's just not all similar tech. So we've got technology in the 10 to 20% range. So we'll have Microsoft as the hyperscaler. We'll have Analog Devices or Lam Research as the chip sector. And then we've got other things like Keyence, which is factory automation, or Cardex out of Switzerland, which is logistics. So there's all kinds of different technologies that we have in the portfolios that probably account for 10 to 20% of our holdings.
All right, let's leave it there. David Driscoll, thanks for joining us. Appreciate your time, sir.
No, you're welcome, Marilla. Have a great weekend.
You too. And thank you for joining us today on Market Call. We'll see you back here again on Monday.